example. Before that, the idea of interest rate parity is very simple. Can the interest rate be different between Gurgaon and Delhi? No. We have a quick movement. People have a choice between Delhi and Gurgaon. You can do that easily. So any interest rate difference will not work. What about Delhi and Chennai? Well, the distance is a lot, but with online banking and trading, again, you can't have a difference. And even if there are difficulties with modern technology for many people, there are arbitrageurs. So you cannot have in equilibrium one interest rate in Delhi and another in Chennai. It has to be the same. The reason is very simple: speculation, trading, arbitrage removes any gap because there's a profitable opportunity. You can borrow where it is low and you can lend where it is high. So in equilibrium, the interest rate has to be the same. Let's extend that example further. Suppose you don't have two regions within a country, but two countries. Let us say within European Union, these are two different countries. Can the interest rate be different? Again, no. There is not much of a scope. There is a lot of mobility within Europe, and also it has the same currency. And now I'm coming to the currency aspect. So the interest rate in two parts of Europe would be the same even if it is two different countries. But what if it is not a Eurozone kind of a situation? Well, let us say you have Hong Kong and US. It is two different parts of the world. It's also two different currencies. However, you have a fixed exchange rate. So again, the interest rate would be very close. There can be differences due to other things, liquidity, some political risk, etc. But if you abstract from those on the basis of your economics of it, the interest rate on debt instruments denominated in Hong Kong dollars would be very close to the interest rate on debt instrument denominated in US dollars. This is when you have a fixed exchange rate. It's a currency board that operates there. So now let's move further. Consider two different countries, and let us say US and India. Now you don't have a fixed exchange rate. You don't have a Eurozone kind of a situation. You don't have a currency board. So what happens there? The interest rates can be different, and as you know, they are indeed different. The interest rates in US are low, very low. The interest rate in India is quite high. So there is a gap between the two. Does that mean that there is an arbitrage opportunity that you can borrow in the US and lend in India? There can be, but not. It's not so straightforward. It's not so simple. Because even though you have, let us say, 1% interest rate in the US and 10% interest rate in India, there is a problem. The 10% in India seems very attractive, but when somebody gets the money here and puts it in a rupee-denominated deposit or bond, then let us say it is for 1 year. At the end of the year, you're going to get back rupees. You put in, let us say, 100 rupees, and at the end of it, you have 110. When you take the money back, because that is what you must consider, eventually it is dollars that you are interested in. So the crucial question then becomes, at what price do you convert rupees into dollars again at the end of the period? Now, if you go by the history of Indian rupee, then you find that the rupee has been, on an average, leave aside the fluctuations here and there, and leave aside the major changes, but by and large, there is a depreciation of the rupee if you take from 1950 to 2013. And the other broad guidelines practice that the depreciation of the rupee rate is somewhat similar to the inflation gap between the two. So if the inflation rate in India is substantially higher than what it is in US, and that is a major standard factor, then you would have the rupee depreciating, which means that it may seem attractive to invest at 10% interest rate in India rather than 1% interest rate in the US, but at the end of the year, if the rupee follows the historical pattern and it depreciates by, let's say, 10% or 8, 9%, here 9% will do. So if the rupee depreciates by 9%, then the gain from the interest income is offset by the depreciation of the rupee, which means that the 1% interest rate on dollars is equivalent to 10% interest rate on rupee. So that is the interest rate parity that we are talking about. Let me take one concrete example similar to what I was just discussing, and then put it a little more formally before I move on to some more applied examples from Japan and from India. What are any questions so far? No? So, consider just to make calculation simpler, let us say the rupee price dollar is 50 rupees per dollar. You have 100 rupees, you have $2, so that's straightforward. Next, consider an interest rate of 10%, so this becomes 110 rupees. Considering 1 year, if you like, you could consider 1 year, but you can consider 3 months, 6 months, longer or shorter period. And if you invest here at 1%, then this is 2.202 dollars. And what interest rate parity would say that if the arbitrageurs, speculators are active, then in equilibrium such profitable opportunities are exploited, with the result that this 110 rupees should be the same as 2.02 dollars, which would mean an exchange rate of 54.45 rupees per dollar at the end of the period. So, does this hold exactly in practice? No, not quite. But that is where profitable arbitrage opportunities exist. That's where the bankers keep looking at the interest rates, they keep looking at the exchange rates, and if there is a gap, then you buy or sell, and if there is considerable competition in the forex market, which there is, and you can have good reasons to believe that the market would be efficient, then you would have a situation close to this. So, yes. Let us say you have 1 rupee invested in India at interest rate I is the domestic interest rate. So this is the amount that you would have at the end of the period. If arbitrage opportunities are exploited, then the no arbitrage or equilibrium condition would be that this becomes equal to what you can get by converting into dollars. So the principle of 1 converted into dollars would become E naught. Maybe I have notation here. This is price of dollar in terms of rupees at 8 0. So I'm considering two dates, date 0 and date 1. So this is the number of dollars that you can get now by converting 1 rupee into dollar. You invest that in a dollar-denominated debt instrument, and let us say that is the interest rate abroad. So I is the interest rate domestic. I star is I'm simplifying, taking the case of India and the rest of the world. India has rupees and the rest of the world has dollars. But as I said, and it's important to keep that in mind because it's getting more globalized. So you need not consider India and abroad, you must consider within India rupee-denominated debt and dollar-denominated debt. So the issue is two currencies rather than two countries. Of course, the two currencies would be due to two different countries, but as I said, the practical example, better practical example of it would be London or even much of Europe, where you can choose your currency denomination. So you don't have to talk about being abroad or being deposits being held locally. Okay. This is the number of dollars. This is the principal. So this gives you the future value in dollars. But remember, this side is in rupees. So you need to convert this back into rupees at the end of the period. And let us say the exchange rate is E1 at this date. Then you would get this equality when the no arbitrage condition holds, that is the equilibrium condition. Now, E0 is known, this is the current exchange rate. E1 is the price of dollar in terms of rupees and is 1. Now, here this is not known, and that is where the uncertainty comes in. But if you have expectations of the future exchange rate based on theory and based on past data, then you would have some basis on which to form the expectations of this. And instead of taking the actual rate which is unknown, you would take the expected exchange rate there. Right, so this is what is called the uncovered interest rate parity. What is the uncovered part? But before that, the parity is that the interest rates are equal after adjusting for possible changes in exchange rate. So unlike the Delhi Chennai example where interest rates would be exactly equal because there is no currency difference, or for that matter between US dollar and Hong Kong dollar, here it is interest rate equalization after adjustment for changes in the exchange rate. If exchange rate remains fixed, E1 is equal to E0, then of course expectation of E1 is E1 itself, and E1 is equal to E0, so that cancels out and you have I equal to I star, which is the example that I was considering earlier. So that is the interest rate parity part. The uncovered part is that there is a risk, and that is not covered because at the end of the period, the exchange rate could be different from what you expected it to be. Today it is 50, let us say I expect it to be 54, but it turns out to be 58, or it turns out to be 53. It can be different. So there is a risk, and that is not covered. It is what is called uncovered interest rate balance. Now, the way it is put here, it is that what in formal economics called risk neutral. That is, what matters to you is only the expected balance. But if there is a risk, and in case you are averse to that risk, then you would keep some premium. In this case, it would not be equal. You would take that. But risk neutrality is not a bad assumption in the context of forex dealers who operate in a large number of markets and who do a large number of trades, and there's also a capital cushion, etc. But that's a different issue. This is what the basic theory is. If you open this up and use a bit of approximation, which I'll avoid, you can get to showing that I is equal to I star plus E of C. C is the change in the exchange rate. This is the expected change in the exchange rate. So to come back to that example that I began with, if the interest rate is 10% in India, it is 1% on the US dollar denominated debt, and the depreciation expected is 9%. That's where you have an equality between the interest rates on debt instruments denominated in two different currencies. The exchange rate between which is
what happens in the case of when the interest rates are more sticky than flexible? Because that they don't change as fast as the flows of funds.
So, if suppose these two are fixed, then this is in a sense quite certain then.
So the exchange rates will.
By the way, this is under the assumption that there is capital mobility across countries or across currencies, and also that it is substitutable, and that there are no tax differences, and there is no difference in liquidity. These assumptions are there. You need to take that into account.
Taking those assumptions, I'm assuming that there is free mobility of capital. But what is the interest rates? Though are there some stickiness? They don't change the capital is moving, but the interest rates take time to adjust. So what happens in the interim? By the time interest rates adjust to this.
Actually, you don't need interest rate to change here. No? And you have the adjustment factor is your exchange rate. Because suppose Indian interests are fixed, US interests are fixed, 1% and 10%. Then what must be expected is that the Indian exchange rate is likely to depreciate by the corresponding factor. So your interest rates are not changed, but your exchange rate has taken care of the adjustment process.
Just to add further to that, the broad standard chart, you could take the interest rate to be flexible. I mean, they may be sluggish and not change much. But here, by the way, we are not talking about changes in the US interest rate from 1% to 3%. This may take a long period of time. For traders and for the short-term capital flows, we are talking about interest rates changing from 1 to 1.1, 1 to 0.9, 0.95. It's in that range that we are talking. And if you look at that, then the interest rate in US is being pretty flexible, though the public perception would be that, yeah, I had seen it around 1% last year, it's around 1% now. But for traders, there is a big gap between 0.9 and 1, and between 1 and 1.1. It's in that range that we are.
If the central banks try to maintain a set level of interest, if they don't like the interest rates to vary too much, usually.
that is the central bank interest rate, the rate at which they would lend to the commercial.
No, I mean they try to maintain a stable by their own operations as such.
No, the central, if you are thinking in terms of the central bank fixing the interest rate, yes, they announce a certain rate and then it is fixed for some time. It could be 9 months as it was in India, between the two changes that happened, or it could be 3 months, or it could be 6 months. So during that period, what is fixed is the interest rate charged by the central bank. However, the market interest rate is different. Just because the central bank interest rate is fixed does not imply that the market interest rate does not fluctuate from day to day. And it is these interest rates that we are talking about are the market exchanges and not the central bank rate. The market interest rate would change due to various factors: liquidity in the market, capital flows, exports, imports, expectations.
Risk factor and all that.
Of course, it is true that given that the central bank has kept the interest rate fixed, the market exchange rate, the market interest rate cannot change too much. That is true. But as I said, for trading purposes, even these small changes are quite a lot, because when you consider these big banks and you consider the amounts of dollars and rupees involved, then even a small change in interest rate can mean a lot of things. And if you consider such opportunities from day to day, week to week, month to month, then it can add up to quite a lot. So in that sense, the so-called small changes in interest rates can be substantial from the viewpoint of arbitrage. That is what we are looking at. In fact, the gaps are really very narrow, but even the gaps can make money. Okay.
Also, I think in Indian context, the interest rates you want to look at, you have to look call money rates. That fluctuates almost minute to minute. Also, the interest rate which the central bank is doing, it's basically for the banks and them. It's not applicable to general people who are investors who want to borrow and all. That's why the assumption of fixed interest rate may be a restrictive case, cannot be a general case.
So, the next is covered interest rate parity. Again, 1 rupee in a rupee denominated at the end of the period we get this much. 1 rupee converted into dollars gives you these many dollars invested in a dollar denominated debt instrument, and you get that future value in terms of dollars. But now the change here is that instead of considering the actual exchange rate in future or the expectation of it, where the expectation is formed now, instead what you consider is a certain forward rate. So you have then the same. I'll just write the final expression here. So instead of the expectation, you consider the forward rate of the market. So at present, you can trade in the spot market, you buy or sell, which is what is more familiar, or you can trade in the forward market. Forward market just means that at date 1, you can remove your exchange rate risk. There is some period of that risk. So you convert it at a known exchange rate. So if the forward rate is this, then there is no risk for you at all. So it is covered there. And again, you have the interest rate parity holding after considering the depreciation of the currency, which is certain as far as you are concerned. there is a little more, but I think I'll take this up if I have minutes time and I'll come back to you.